Give me a lever long enough and a fulcrum on which to place it, and I shall move the world. Ancient Greek mathematician Archimedes said that. The concept of leverage in finance is derived from the mechanical lever described by him in that line. It refers to finding a way to use the least force possible to move a weight you otherwise wouldn't be able to. With the lever resting on a fulcrum, you can lift a load no matter how big. Or can you? While Archimedes proposed that leverage can achieve anything, it doesn't always hold true, especially in financial terms. Now, before we dive in, you should note this information does not constitute financial advice and is not intended as a substitute for consulting with an experienced professional. Okay, now that's out of the way, what is financial leverage? Financial leverage is when you use debt to purchase more assets and as a result, amplify the returns you get on an investment. Similar to how you'd use a lever to lift a load heavier than you'd ordinarily be able to, you can make much higher returns through leveraged investments. Say you have $1,000 to invest in a financial asset that will give you 50% returns. So to make more out of it, you borrow $5,000 from your friend. You put in $6,000 in total to make a $3,000 return. In total, you now have $9,000, the initial capital plus return on investment. You give your friend their $5,000 back and you pocket the $4,000. Great, right? Without the leverage, you would have made 50% on your $1,000, giving you a grand total of $500. While this example is oversimplified, it doesn't take into account borrowing costs. It shows how you can use other people's money to make more for yourself. Leverage can also be used to enhance your cash flow streams. For instance, instead of using all of your cash up front to invest, you could get a cash injection from a third-party source and front only a portion of the cash. That way, you can use the money left over to invest in other instruments or do other things, so you don't have all your cash tied up in a single investment. For example, if you want to invest $5,000 in stocks, you borrow $3,000. This means you only put $2,000 from your own money on the line. You can use the rest to invest in other securities to diversify your portfolio and reduce your overall risk. Leverage is a great way to multiply the upside risk on investment. So, when can you use leverage? Leverage can be used to multiply the returns you get on investments. For instance, you can leverage your position through margin trading when trading Forex. Margin trading simply means the broker provides you with the funds to trade. For instance, if you're required to put 1% of the transaction value on a 100-to-1 margin, you'll need a $1,000 deposit and you get to trade for $100,000. You can also use the concept when trading derivatives. Say you want to make money on stocks without the full-on commitment of paying up front. So instead of buying $1,000 worth of stocks, you can use $300 to buy options that bet on the stock's return. Put options lets you bet the price will fall so you can buy the stock at a lower price. Call options bet on the price going up. If it doesn't happen as planned, all you lose is the money you used on the option instead of the entire $1,000 you would have invested. All of this sounds lucrative enough, but it can be very risky. You can go broke. Leverage gone wrong. The concept of leverage is based on using other people's money to make some for yourself. But if the market tide changes, you could be left high and dry. Picture this hypothetical scenario. You borrow $5,000 to invest in some financial instruments, say stocks, for $10 each with a forecast of a 100% return on your investment. Unfortunately, the market tanks and the price falls. You can't go back to the lender and tell them you can't pay because you lost your funds. You'll still be expected to pay up, plus the interest on the loan. Even if you were to sell off the stocks, you won't be able to make up for the loss. In contrast, if you had invested your own money, you would have just lost the $5,000 and nothing more. So in effect, leverage amplifies the downside risk as well. If you win big, but if you lose, your losses will be tremendous. Consider the case of Bill Huang of Archegos Capital. After building up a net worth of over $20 billion, it all came crashing down in the space of 2 days. Unfortunately, the collapse of Archegos also dragged several big banks into loss positions. Huang borrowed massively to build a $100 billion derivatives portfolio. His borrowings were at least 5 times his net worth. The main underlying assets which he betted on included tech stocks like Viacom CBS, Shopify, and GSX Tech EDU. Derivatives are a special type of financial asset that gets their value from another asset known as underlying asset. In Huang's case, the value of his portfolio depended on the rise or fall of the share prices of the underlying tech stocks. When share prices fell, Huang defaulted on loans and, in the process, lost everything. Several major investment banks such as Morgan Stanley, Goldman Sachs, Wells Fargo, and Nomura that acted as prime brokers, the main lenders for Archegos, also recorded significant losses. Another example is how many people lost everything with Bitcoin. Enticed by the high-flying price of Bitcoin, many sold their houses or borrowed heavily to put it all in Bitcoin. The price came crashing down, wiping away their entire investment and leaving many in a fix. They still had to repay debts. On the Wall Street Bets subreddit, the hashtag #LossPorn will take you to scores of astounding losses, many of them the result of leverage. So, should you ditch leverage altogether? Not entirely. Using leverage to boost your earnings is an age-old concept for a reason. Done right, you can increase your income considerably using other people's money. However, the concept of leverage is an extremely complicated one. It only works if practiced in moderation combined with a thorough risk assessment. Investors sometimes get carried away. A few trades go well, markets move in your favor, and you become overconfident. You decide to take on more debt to go all in, increasing the risk factor. The higher the risk, the bigger your potential fall, so don't gamble with your investments. According to Warren Buffett, when you combine ignorance with leverage, you get some pretty interesting results. A financial plan that consists of, oh well, who knows, maybe it'll go to the moon, no risk, no reward, right, has led many to become broke. So take the ignorance factor out of it. It helps to have a clear strategy in mind and ensure you stick to your thorough research. In addition, it's a good idea to not take excessive risks. If you take 20-fold bets with borrowed money, you'll likely lose big. Instead, put a cap on the risk you're willing to take and stick with it. For instance, some people follow the 2% stop-loss rule. This means you don't put anything more than 2% of the investment amount at risk. Say you're trading on a $50,000 account with a 10% leverage position. This means you've deposited only $5,000 in the account. By using a 2% cutoff, you can only risk up to $1,000 on any given trade. You would have to make several bad calls of $1,000 each to make a substantial loss, which is highly unlikely. Most importantly, remember investments are not a get-rich-quick scheme. Pace yourself and have realistic expectations. Leverage is not a magical golden ticket to a rich life. Many have risked their whole life savings on the premise of leverage and lost it all.